Hello and welcome. Today we're going to be talking about a stock which has doubled over the last 1 month. That's not really the reason why we are speaking to them. There's plenty happening in this. One is, of course, they've ventured and they've bought GScale, which is a company in the data center space. They're into turnkey solutions, by the way, and therefore data centers could actually be the next big leg of growth. And the presentation which they put out post the acquisition seems to suggest that they want to cover more breadth with regard to data center, especially on cooling solution side and the power side, which is obviously one of the key or two of the key requirements where data center scale is concerned. So standard engineering, therefore, in focus. The third piece that we're keen to know is the huge capex that they've slotted and the kind of growth dynamic. They're currently a sub 800 crore top line company, looking at a 4,000 crore top line on their current business alone. And then on top of it, then you have data centers as well. We'll try and understand as to how quickly that scales. And last off, I want to very keenly understand on the standalone and the current business, how are margins and growth going to trend, and how quickly can they go towards the 4,000 crore number, especially with regard to margins. There's been a bit of a fall when you're looking at the FY26 margins. We'll come to that, and maybe we'll try and get a sense as to what's in store for FY27, because the commentary is extremely strong, at least at the end of Q4. Let's take a bit of a step back, try and understand the business itself. Incorporated in 2012 in Hyderabad, listed in 2025, market cap of around 5,500 crore, but has doubled just recently over the last month or so. What it does is it's in the specialized process equipment space. It's promoter-led largely in terms of the platform itself. Now let's try and understand the story. Really the story is that whenever a pharma or an engineering or a chemical company wants to set up a factory, what you need is equipment within the factory. And what standard engineering does is it provides end-to-end engineering solutions from reactor to the manufacturing plant as a whole. And it builds the reactor in-house, so it does it itself. And that's where the larger margins are made. We'll understand what exactly a reactor is in just a minute. But basically, it's from equipment manufacturer to turnkey platform. That's been the journey of the company. And the linkage of the business is capex in pharma, specialty chemicals, biotechnology, and now data centers. All of that will be the key play here. In terms of what exactly is a reactor, right? This is something which is important, and it's basically a reactor is simply a very large industrial scale vessel, right? And chemical reactions happen inside the vessel. There is different types of glass lining which ensures temperature control and the like, and therefore that is largely required within the pharma and the chemical space to manufacture various and store as well various pharmaceutical and chemical products. So that is something you want to keep in mind. In terms of business verticals now, the first vertical is process equipment, which is on your screen. So it manufactures reactors, tanks, heat exchangers, largely used in pharma and chemical manufacturing plants. Products built to withstand highly corrosive chemicals, extreme temperatures as well. I spoke a little bit about that. And this is the largest contributor to revenue, process equipment itself. There are high entry barriers, by the way, to this business due to the engineering expertise and regulatory requirements that are required to be complied with. The other piece is turnkey, and this is a little bit forward integration, right? What they've done is they also now design and execute complete manufacturing facilities. They handle engineering, procurement, fabrication, commissioning, all of that. And it's a single point solution which they provide to their customers. Higher value addition, that's what they make on this, and it's a growing share of the business. In terms of the third piece is the new growth businesses which they are entering into. So bioreactors, nuclear reactors as well could well be the opportunity of tomorrow. Fermentation systems and the Skygenics acquisition allows them some of these, nuances. The pre-engineered building products and precast industrial buildings also is something that they've started to enter. And AI data center infra, I spoke about that through one of their subsidiaries which they've just bought. I'll talk a little bit about that subsidiary as well. And they're expanding beyond pharma and equipment, which is what is creating the kind of buzz on the stock on the stock price as well. What they've done is they've bought 51% in GScale Energy. This is a strategic entry into AI data centers and engineering infrastructure solutions. Phase 1 will include will be an investment of approximately 200 crore. The program has a total investment of around 500 crore. The entire program, they're saying, is going to be funded through internal accruals. Manufacturing to start in November of this year itself, and then scale very, very quickly from there. There's a significant adjacency, but this is a clear diversification beyond the current business that Standard Engineering does, because they have had no presence earlier in the data center space. And therefore, let's quickly take you through all the products that Standard Engineering essentially sells. Glass-lined equipment, now this is reactors, which is the containers in which manufacturing process happens. Storage tanks, which is inventory storage. Receivers, heat exchangers, they do all of that. Metal process equipment as well is something they do. Stainless steel reactors, nickel alloy reactors, filters and dryers, vacuum systems. Those are just some of the products that they do. PTFE flow systems and lined pipes, fittings, valves, and the like, which is corrosion resistant to chemical transfers. Biotech equipment is something that they do, which is bioreactors, fermentation systems, clean room environmental systems, lab and testing equipment, and the like. Then there's turnkey solutions, the plant design and process engineering, equipment integration, installation, commissioning, and all of that. So really, that's how you probably kind of break up the 4 verticals of the company. Let's talk about the profit and loss and the financials as a whole. In terms of the first metric, which is P&L, you've seen a decent 16% 3-year CAGR on the top line. If you look at the FY22 number, it was far lower, and therefore the CAGR would have been stronger on a 4-year basis. When you're looking at EBITDA, that's grown at 11% because of margin compression you've seen, and that margin compression has largely been back-ended, which is FY26. FY25 and 26 has seen some bit of that. So keep an eye out on FY27, because the margin guidance seems to be 18% plus. So we'll try and wait and watch as to how that plays out, and we'll ask management as well as to what's really changing in the environment. Last off is net profit. Net profit has grown at 16%. We've given this a thumbs up largely because mid-teens kind of growth looks okay. When you're looking at the margin trajectory, and this is what you'll see, the margin has shrunk sharply in FY26 versus FY25, 24, and 23. When you're looking at the balance sheet now, and maybe we're a bit cautious on this, but if commentary is anything to go by, then margins will recover. When you're looking at balance sheet, it currently has an 800 crore book value. It trades at around 7 times book. You've got borrowing, which is clearly expensive. Borrowing is approximately 60 odd crore, and therefore no concerns there. And there's a cash bank balance of around 115 crore. There's an acquisition in place as well. We'll try and get a sense as to what changes with regard to the balance sheet as a result of that acquisition. But thumbs up for now, no concerns. When you're looking at cash flow, that's where the possible concern lies. The conversion is not happening from EBITDA to cash. We'll try and get a sense as to what's playing out. Of course, delays is one of them. Also, inventory is the other. We'll try and get a sense as to what's playing out here. Fifth piece is return ratios. You've seen return ratios actually hold up fairly well, even though FY26 was a tough year, FY25 was a tough year. So we've given this a thumbs up. But you could start to see a recovery just because of the kind of growth that you're seeing, but also there's large capex involved. You'll try and get a sense as to what plays out on the return ratios as a result of the capex, but they've traditionally done healthy return ratios. Also, pre-FY25, they were in the listing phase as well. That's something to keep in mind, and therefore those higher return ratios maybe also from a perspective that at that point of time, equity was slightly lighter in that sense. So something to kind of factor. When you're looking at shareholding pattern, now you've got 61% promoter ownership out there, but 20% of it is pledged. So that's something you want to keep an eye out on. FIs, DIs have very small holdings, and the public has a 37% holding. So that's the structure of the shareholding. In terms of valuations now, Standard Engineering, the average valuation was around, sub 50 times last 1 year odd. But we've seen a rocket on the stock because of the way in which the re-rating has happened post the entry into data center, and therefore currently trades at 68 times. HLE Glasscoat, which is in the similar coating space, it trades at around 50 times. So that's broad brush the way in which valuations are. We're cautious, obviously, but at the same time, the kind of growth prospects that Standard Engineering is offering is extremely strong. We'll also get a sense, a large part of the revenue currently comes from domestic, whereas international could well be the front in which growth could come in at. So that's broad brush the setup. Let me bring on board Nageshwara Rao Kandula, who is the Managing Director at Standard Engineering and also the promoter. Mr. Kandula, great having you. Let me first start off with this acquisition, right? Give us a sense of, one, the price that you have paid. Second, the funding of the acquisition. You currently own 50%. Does that go up when you do your equity infusion and when you fund the capex plans of the company?
Thank you, Harsh. Well explained about the SCTL. And first, I want to clarify, this is not compared with any company. We are not only glass lining. We recent days, we changed name also. End-to-end solution we are providing. We have 180 variety of products we are manufacturing in SCTL. Pharma and chemical, complete related jobs we are manufacturing. We are concept and design and supply and commissioning up to water trial. Customer full solution we are providing. That is one part SCTL. And second SCTL, GScale, we are investing 51% stake and we are investing first phase capex 125 crores investing on GScale manufacturing facilities. And the second phase we are going to invest maybe coming 6 months, 7 months, another 75 crores we are going to invest. This is after 800 crores revenue, another 150 crores we will pump. After 1,500 crores revenue, then we will pump 70 crores. Phased manner and milestone based, we are pumping the fund to GScale.
Right. Now, in terms of GScale, talk to us currently about the revenue. You're currently at 800 crore. When you integrate GScale within you, where does revenue go therefore? So how much is the revenue of GScale? Also, my understanding is that around 250 crore of revenue will come through in the current year itself, which is FY27, from GScale into your books. So is that the right kind of numbers in terms of, and this starts in November, so it's a 1,000 crore kind of business run rate annual?
No, existing business, I guided 40-50% growth minimum. That is SCTL existing product growth point of view. And GScale is going to where the way we 250 crores revenue because of third quarter maybe partially revenue and fourth quarter full-fledged revenue. Then so total, yes, almost it going to SCTL revenue next 27 financial, it almost double.
Right. So yeah. So I mean, you'll go towards maybe 1450 crore. If you're saying it's going to be 300 crore quarterly run rate, 1200 crore annual, 50% growth, and plus the 250 crore of GScale. But what happens?
40-50% growth is SCTL existing business, and we are very confident GScale is going to generate 250 crores revenue.
Correct. I've in fact factored in the higher end of that 40-50% growth rate band which you've just given. So from 800 crore, you go to 1200 crore is what I've ballpark taken. So maybe 1400 crore is where you end up FY27. That's broadly the number. So understood. With regard to GScale in particular, what happens FY28? Are you going to clock a revenue in GScale of 250 crore plus quarterly? Is that something that we can expect?
Very, we are expecting also. Why? Because of GScale MD, Mr. Brahma Reddy, he have a lot of experience in the tier 4 data center build experience, and also he have a lot of contacts, and also they have product, every product they design and prototype they made, and whatever related data center related products. Also, suppose 1 mega we want to set up a data center, we required expenditure almost 50 crores. 60% products we are involved. We are going to manufacturing in the related data centers. We are going to even including installation up to handout to client. That we have the GScale capabilities. They can design also data centers. They have very good team, and we are very confident 28 financial year also very much growth compared to maybe minimum 30-40% is going to grow more than I'm very confident that GScale growth.
Understood. I'm also interested to understand that in the presentation that you've put out for GScale, you said the products that GScale is doing, most of it is imported. Can you describe that piece? How much is the import requirement? What are these products that you're speaking about that GScale does, which are imported? What composition of the top line is the product which is imported really looking at? So the Make in India initiative?
And that is almost currently 40% products are really, 40% products are importing. That parts we are going to manufacturing, like a CDUs, like some different intellectual products they are importing. First we are targeting CDUs. One cooling system, complete cooling system, completely they are importing from Europe and US markets, and we are going to manufacturing that in-house. Already designs and parts, everything is completed, and a prototype also we made.
And the margins will not be margin dilutive for you, 18-20% margins even in GScale or even higher?
GScale margins are going to higher.
How much?
Margins are minimum, we are expecting 25 to 28% EBITDA we are expecting from GScale margins. And SCTL margins also going to grow this year because of we are systematic execution, and we are added product mix also we added existing business and tight procurement we are doing. So one side SCTL margins going to slightly increasing, and GScale we are expecting 25 to 28% EBITDA margins from GScale.
Mr. Kandula, I'll come straight to that. I need to slip into a very short break. I'll come back. We'll talk about standard engineering, the traditional products. 40 to 50% growth is the guidance that Mr. Kandula has given us. What's driving that growth? How much of it will be export? How much of it will be domestic? We'll try and get a sense of all of that on the other side. You want to stay with us for this conversation. Welcome back, and we're speaking with Mr. Kandula of Standard Engineering. Stock has doubled over the last month or so. We're trying to get a perspective as to what's playing out. Mr. Kandula, you said 40 to 50% growth on the top line. You are to a certain extent linked to the chemical and pharma cycle. What's keeping you so positive? The order backlog, of course, 1,000 crore order book, but is that order book continuing to build up? And just give us a sense as to whether you're looking at other geographies. What are the levers that you're relying on?
Right. After first quarter completion billing, and still we have 1,400 crores order book. Because why customers are choosing SCTL today? We are providing complete solution, not partially product sales. We started initially product company, and slowly we became a end-to-end. Customer is looking for solutions. Then SCTL started selling solutions. Now customers are also looking for solution provider. That's the reason today our growth is existing business is almost 50%. And the last year, 25 FY25 to versus FY26, our export also doubled. This year also we are trying to increase our exports, and slightly war effect is there, and US and Europe markets. But still we are trying to get the good export orders.
Mr. Kandula, on the 1,000 crore order book, I read that the export order book was 30 crore rupees. At
Yes.
1,400 crore, what's the export order book?
We are expecting good orders in pipeline. We are waiting for the last 3 months. Lot of disturbance is due to war. But any moment, if you 1 or 2 orders confirm, then it will going to again top line. We are going to add another possibilities are there. 10% export possibilities are there this year also. We are looking for that order confirmations.
10% of the order book will be exports. Is that what you're trying to say by the end of FY27?
Yes, possibilities are there. Possibilities 2-3 we are discussing with export clients. Then possibilities are there.
What geographies are you looking at in exports? I understand you're looking at Middle East. You
Majority,
also have a subsidiary in the US.
majority we are doing currently. We are doing US. We have very strong partner in USA. They are our reseller, our products in Europe and US markets.
Okay. Are export margins better than domestic? And say, for example, if I push it to the next 3 years, say your revenue goes up from the current 1200 in SETL standalone, it goes up from 1200 to say 2000. What will the split be, export versus domestic, at that point of time?
We are targeting actually export at least to slowly we will increase at least to 30 to 40% we are targeting export. And also US also new plants are coming. We are also trying to some arrangements, going to arrangement with some engineering companies because of local rules and regulations. And we don't know. That's the reason we are trying to some arrangement with the local engineering companies. Once these arrangements happen, now currently we are independent equipment only we are supplying to US markets. Once that engineering, our company and US engineering companies are collaborated, then we will start providing the solution. We will start selling solution to US markets also. Then our revenue going to sharply going to increase.
When is that expected to come in?
Coming to we are on the work very hard, and our recently that purpose, you are aware, I think the AGI Inc. Japan is 2.5% shareholder in this company. That company CEO recently he became an executive director in the board. He's looking at global operations, global sales and operations now. It's going to, I'm very positive.
But is there a timing? Will it happen? Will the collaboration with US companies happen FY27, FY28? When does it happen, sir?
FY28, I hope FY28, damn sure it will going to happen.
Okay. So FY28, you'll start to see orders trickle through with regard to US exports, which will be much stronger. So my sense is that delivery for that will happen only in FY29. Is that fair in terms of the assumption?
28 also some deliveries will happen. Recently, 27 and 26 we sent a lot of 100 crores worth of material to US market, and that their customers are visiting, some equipment installed in customer place. Now we are getting very satisfaction feedback from clients. Repeat orders also slightly started, but today we are selling only independent equipments. That is I'm saying 28 FY28. It's going to a solution sales. Then the revenue is going to increase. I'm expecting, I hope. And also Japanese director also continue focusing on that sales, global sales.
Could you quantify the number for FY28, the global?
At least,
tough to do.
At least we will add 15-20% export.
15 to 20% of the top line will come from export. So say you do 1200 crore of standalone top line or SETL level top line in FY27, you'll if I'm assuming 1500 crore FY28, which is 25% growth, 10% of that will, maybe 15% of that will come from exports, is what you're saying. So maybe 200 to 300 crore from exports.
Yes.
Okay, noted. And sir, with regard to margins, what led to the margin decline FY26?
FY26 we recruited a lot of employees, and also some of equipment made a R&D based, and some of equipment we developed different aspects and offer the customers first use purpose. Some slight price reduction happened. Now FY27 again it is going to back, our margins are intact.
Okay, and what gives you the confidence that despite raw material prices going up, you'll still likely hold on to margins? Is that a pass-through when you win an order? How does raw material pricing work?
Whenever generally normal orders, once we receive orders, same week, same day, we will book the raw material also. That is not going to affect our business raw material price increase. But long-term orders, complete solution, if you are providing any price escalation, we are going to pass on to clients. Clients also agreed, that is there in our agreements also.
Okay, and cash flow, that has been a little bit challenging. EBITDA is not getting converted to cash. Is that a concern in your opinion?
This is the earlier is there. Now we changed our payment terms and conditions with the clients. This year we are very positive cash flows. We are going to this year. Last year I think we positive cash flow 45 crores. This year maybe we are going to touch 100 crores positive cash flow.
Excellent. Okay. Thank you so much, sir, for coming in and speaking to us. That gives us a lot of clarity. 100 crore cash flow, very likely. Even though margins will ensure that EBITDA comes in at maybe 200, 250 crore maybe. That's the kind of number which we could see in terms of EBITDA. So EBITDA may double, but cash flow still lag. But at the same time, you'll do 100 crore of cash flow. Really, that's the understanding from Mr. Kandula. Out of time on this edition of All About Your Company. Thanks so much for tuning in.